Advanced Financial Accounting. In this presentation, we're going to work a practice problem related to a consolidation. We're going to have a consolidation this time using the cost method. So we're going to have two companies. We're going to show the consolidation. P, one company is going to be owning 100% of the shares of S, the other company, and we're going to assume that the purchase took place at the beginning of the current year, for the net asset price of the company that was purchased, that being Company S. Get ready to account with Advanced Financial Accounting. Note, this problem will be similar to a prior presentation where we had a similar problem, and we're going to be focusing in on some changes as we go. Because remember, when we look at these consolidation problems, there's a lot of variables that could take place. So we want to start off with something that's fairly simple, get the concept down, and then change some variables in complexity so that we can focus in on how those changes affect what is going on. What's going to be the change here? This time we're saying that we're going to be using the cost method. In other words, we're consolidating P and S being the two companies, but instead of P carrying on their books their investment in S before the consolidation using the equity method, which you would kind of assume would be the most appropriate method, they're just going to carry it at cost. And the justification there being, they're saying, hey, look, we're carrying this at cost. It's a fully owned subsidiary. We plan on doing a consolidated worksheet anyways. So you could take a look at the consolidation worksheet to see us combined together. It's the easiest thing for us to just carry this thing at cost. Now, to carry it at cost is similar to the fair value method that we would use if we had less than 20%, except that we're not going to be recording this up to the market value as we would do under the fair value. We're just going to record it at cost under the investment and just basically leave it at that. Also note that we have the other simplifications here that we're going to make the assumptions that one, this transaction happened or the consolidation happened at the beginning of the current year. So it happened January 1st of the current year that we're working on, and now we're doing this consolidation worksheet as of the end of that year. So now it's the 31st. So we have a full year of one company completely owning the other company. 1 year, it has been 1 year exactly. Then we're also saying that the purchase took place for 100%. So P does not just have a controlling interest, they have 100% interest in S for an entire year that we are looking at. When the purchase took place as well, the purchase price was the same amount as the net assets. And so that's going to make it a bit more simplified as well. So the purchase price happened to be, was worked out to be the same price as basically the book value of S, meaning assets minus liabilities, or in essence equal to the equity section of S. Let's go to the problem here. We're going to have the data on the left-hand side. We're going to be working on our worksheet on the right-hand side. We're going to say that P acquires 100% of S. So P company acquires S company. So it's going to be a parent-subsidiary relationship here. Parent-subsidiary relationship. Not only that, not just a parent-subsidiary, not just owning over a controlling interest over 51, but 100%, remember. So therefore, we're going to have this consolidation take place. We have the common stock for $307,000 was purchased for the book value. So in other words, we're trying to say here that P purchased the book value of S at the beginning of the current year. So it's the end of the year that we're consolidating. At the beginning of the year, the book value of S, equity accounts, in other words, equaled the 307. That's what the purchase price was that P purchased it for. And then P decides to carry S investment at cost. So they're going to say, P's just saying, hey, look, I'm not going to use the equity method because we're going to consolidate anyways. I'm just going to carry the investment at cost. And then the purchase happened at the beginning of the year. So here we have same kind of scenario as with the prior presentation. We got our worksheet. We're going to say, hey, would you give us the trial balances for P and S? Then we're going to put them side by side. I'm going to put them side by side and combine them. Now, in this presentation, that's going to be very easy to do because we can just put them side by side and add them up. In practice, it would be more difficult because the two GL accounts are probably going to be more detailed and have some slight variations in them, especially the expense accounts typically. So some people group expense accounts and name them one way. Some people name them a different way. If they just consolidated at the beginning of the year and we're trying to match up two completely different set of books, even if in the same industry, it's going to be time consuming just to line up the accounts in a proper fashion. Then as you go forward, you're going to want to get better and better at that. You're going to want to be able to consolidate the GLs of these two companies to make the year-end consolidation as easy as possible. If you were to, by the way, create an S corporation, be a P company that creates an S company, then you want to do that from day one. You want to tie these things out so that you can make that as easy as possible. But we've done that, and now that is as easy as possible. So we have these two things that are lining up. The GL accounts are pretty much the same. So we got P's books and S's books. And we're just going to add them up then. It's great. So then we have the 248,000 plus the 78,000 for cash is the 326,000. Accounts receivable, the 200,000 plus the 75,000 is 275,000. Other assets, the 197,000, 77,000 is the 274,000, and so on and so forth. Now, this is all similar to what we saw in the prior presentation. The thing that's different is how they carried the investment. Notice P here is carrying the investment here at the 307,000. We know we have to eliminate that amount because we can't have this investment showing on the consolidated statement, basically showing an investment in ourselves. We can't have, an investment in ourselves. So we know we have to remove that. But how did we get to this number? Because last time when we used the equity method, given all of the assumptions that we've made here, we saw that line item basically would represent all of the equity portion. If we add up all of equity, it would have lined up to that if we were using the equity method given the assumptions that we have gone over here. That's not the case this time. Why is that not the case? Because we're just carrying it at cost. They're not doing the equity method. What does that mean for them to carry it at cost? Well, let's take a look at the journal entries. So it's kind of like the fair value method, but they're not going to be tying it to the book value, basically the stock market price, but they're going to be doing the other method, right? So they're going to what would P be doing? They'd say when they had the investment, they debited the investment at cost, 307, and the cash they paid, 307, which happened to be the same amount as the equity portion at the point of time that the purchase took place, which isn't the same now at the end of the year, the same at the beginning of the year, January. And then when they got a dividend, notice S issued a dividend here. Note, we broke the dividends out. So you might, in practice, like some companies might include the dividends in retained earnings. You'd have to go into retained earnings, figure out there's the dividend that went out. We broke it out in a separate equity account so we can see it here. There's the dividend went out from S. Where did the dividend go? The dividend goes to the owners, to the stockholders. Who are the owners of S? P. So P got 100% of the dividends because they own 100% of the stock. So that dividend went to P. So P then had to record cash going up. They record cash going up on their books. The other side then going to dividend income, which you would think is normally the process for the fair value method, not for the equity method. So this is basically fair value method, except they don't have that last transaction, which is saying, let me revalue the investment in S to the market value. That wouldn't make sense considering they own 100%. So what they're doing instead is saying, hey, look, I'm just going to do the simple thing, record this like a fair value method, but not revalue the investment, because anybody that's interested in P wants to see the consolidated worksheet anyways. They'd like to see the consolidated financial statements because P owns S. They have complete control over it. So if I'm an owner of P, I'm concerned if I'm looking at the big picture, I'm concerned with the full financial statements of what P owns, which includes all of S, 100% of it. So P's saying, hey, I might as well just record this at cost and then show the consolidated financial statements. That's what people are interested in for me. So that means that this 307,000 is just at cost, what it was purchased for at cost. Okay, so given that information, we're going to go through and say, oh, what would the consolidation entries look like? It's going to be a little bit different than if this was at equity. So we're going to say, all right, so here's going to be our information. We got our eliminating entries over here that we're going to be entering. This is kind of like a worksheet that you would have for the adjusting entry process, you'll recall, as with the prior presentation. However, these entries are not going to be something that the books will actually post. So we're not going to be posting this to either P's books or S's books. They're just eliminating entries for the combination. In other words, P's books and S's books we're saying are correct as of now. The consolidation is incorrect because there's double accounting for certain accounts. So we know, of course, this account is going to be double accounted. So we have to eliminate that. So that's the first thing I would think about. We'd say, okay, well, there's a credit of the 307,000. We know that's got to be removed. So I'm going to credit it for the 307,000. That'll take it back down to zero. We know that has to be zero. What's the other side of that transaction? Well, we know when they purchased it for the equity at the beginning. Now, in this practice problem, we can see that the equity here is going to be what's in equity right now. So, right, because the equity has the 206 in it, and the retained earnings is the 101. Now the common stock, once the transaction took place, once P purchased 100% of S's common stock, all the common stock is now owed by P. There's not going to be any more stock issued by S typically if it's going to be completely owned by P. So we know that basically when this purchase took place, this was purchased at cost. So we're taking that off at cost. And then we know that the common stock was probably the same because it's not going to change. They're not going to issue any more common stock. It's on the book, we're assuming at par value at this time, right? So it's going to go off the books. And then the retained earnings happens to be the same amount here because it's the first year of operations. What does that mean? This retained earnings is the same retained earnings that was there at the end of last year for S, which is when the consolidation took place. Nothing was posted to retained earnings because retained earnings is just going to change by the net income rolling into retained earnings as well as the dividends. Now remember, again, the dividends sometimes would be reported within retained earnings as a decrease to retained earnings. We've broken them out to a different account. Therefore, retained earnings now represents the same retained earnings as of the beginning of the year, and therefore it's going to be removed entirely. If it wasn't the first year of operations, note that you could still figure out what the retained earnings should be decreased by. It wouldn't decrease the retained earnings down to zero, however, in that case. But we could figure it out because we could say, okay, there's the cost minus the stock portion, and we could figure out then through, debits minus the credits, what the retained earnings should be reduced by. So in this case, it happens to take away all of the retained earnings given the fact that it's the first year. All right, so then if we record that, that's going to be the other side. And that's kind of like the reversing entry for our purchase here over here. So you'll recall that we had the initial investment, putting the investments on the books at the 307, and then the cash. So we're reversing that, the 307 going off, and then we're reversing the other side that was reported by that is reflected by S, that being the equity section. So in the equity section, if we post that out, then we have the common stock, 493 plus the 206, that adds up to the 299 minus S's portion. The 206 brings us back to P's portion, the 493. Retained earnings, the 561 for P, the 101 for S, adds up to the 662. Then we're going to reverse all of S's portion, given the fact that it's the first year, and that all represents retained earnings as of the beginning. That gives us the 561, which is all of P's this year. Again, that would not necessarily be the case if it weren't the first year with all the other conditions that we've talked about, 100% ownership and whatnot. All right, and then we have the dividends. So we got the dividends here. The dividends still went 100% from S to the owners of S, which are 100% owned by P, because P owned it 100% for the entire year. Therefore, this needs to be eliminated, and the other side of it is in dividend income. So we're going to remove the dividends and the dividend income. So the dividends then, 102 plus the 26, the 128. Then we're going to credit or remove the dividends for S. That brings us back down to the dividends for P, because the dividends for P actually went to people outside of this consolidation. And then we have the dividend income down here. So that dividend income here is represented as income. Obviously, there's no dividend income for S that's related to the issuance of P or S, and then that's going to give us a total of 26,000. We remove that 26,000 back down to zero. Then we have the same kind of thing going on with the accumulated depreciation we talked about last time, so let's post it and then just consider it. Accumulated depreciation, we're going to remove that 15. So we got the 455, the 30, that brings us up to the 463. We're removing 15 to bring the accumulated depreciation down. The contra asset is decreasing. The other side is going to the building and equipment, the property, plant, and equipment. It's decreasing that as well. Why? Because we want to put the S's property, plants, and equipment on the books at the book value at the point in time that the consolidation took place. When was that? At the beginning of this year. How do we get the 15,000? Because there's 30,000 in it right now. 15,000 of depreciation was recorded this year. That means the difference between those two must be what accumulated depreciation was at the beginning of the year, 15,000. So if we net out the 192 minus the 15, we want to represent that at the book value as if like a purchase took place in essence, as of the point in time of acquisition. and then record depreciation as it happens from that point forward. So if we pull everything else forward, notice there's no net change between these two accounts, but we're reporting the book value as of the point of acquisition, and then the increase in the accumulated depreciation that's allocated to S is only for the current year. There is no basically accumulated depreciation as of the beginning of the year, because that's when the consolidation took place for S. That's going to be kind of the objective, but we're still recording the depreciation expense for the current year, and that'll be the accumulated depreciation will then accumulate for S's portion of the accumulated depreciation after the point of consolidation. So there we have it. So same kind of process, similar kind of reversing entries we have over here, slightly different kind of conceptually if you're thinking about P carrying the information at cost versus the equity method. We then have the consolidated trial balance. We're all in balance down here now. You can see that on the income side, the net income before was the 289. We removed the 26,000, which under the cost method was the dividend income that was recognized. We removed, of course, the investment. We removed the other side of it, which would be the equity section recorded on S's books, and then we'd had that adjustment for the accumulated depreciation, the property, plant, and equipment. We can then use these numbers to make our consolidated financial statements.